Welcome back to the deep dive. We're here to give you that shortcut, to being genuinely well-informed. We take all the complex stuff, sift through it, and pull out the absolute core insights you really need. Today, we're diving deep into a company that's basically shaping our modern world, but, well, often goes unnoticed. Amphenol Corporation, ticker APH. Our mission: to unpack the research, grab the most important nuggets, and just make the complex stuff clear and actionable for you. Now, here's the really fascinating kicker, the big tease for our conclusion today. Despite being absolutely critical in these huge waves of AI, 5G, electrification, the market seems to view this, well, premier performer as being fairly valued. A top-tier company, sure, but at a premium price. So the question is, what does that actually mean for investors?
That's exactly what we're digging into today. Our analysis is based on this comprehensive report, Amphenol Core Deep Stock Research. And just for context, all the data we'll talk about is benchmarked to June 22, 2025, and Amphenol stock closed at $93.81 on June 20th.
Excellent. So let's lay out the roadmap for this deep dive. We've split it into two main parts. Part one, we'll build that foundation. We'll look at Amphenol's core business, check out their management team, and dissect their financials, which are pretty impressive. Then in part two, we shift focus. We'll cover market sentiment, their kind of unique ownership structure, the key risks they're facing, and then pull it all together for the final conclusion. Oh, and before we jump in, quick reminder, please do like and subscribe to the Stock Analytics AI YouTube channel. It helps us keep bringing you these deep dives. And for our members, the $4.99 a month ones, you get priority on ticker requests. Plus, big news, over the next few months, Stock Analytics AI is covering all S&P 500 stocks exclusively for members. Okay, so to really get how Amphenol became this unseen backbone of our digital world, we need to start by peeling back the layers. What do they do? How did they get so essential? Let's kick things off at Chapter 1, Business Analysis, the unseen backbone of the electronics revolution.
Right. So Amphenol isn't selling directly to you or me. They're working behind the scenes, a classic B2B, business-to-business model. They design, they manufacture, they market this huge portfolio of highly engineered interconnect products. Think connectors, cables, sensors. Their money comes from direct sales. But here's the key. It's to a remarkably diversified global customer base. We're talking OEMs, the original equipment manufacturers who use Amphenol parts in their final products, EMS providers. Those are the companies assembling electronics for other brands and lots of electronics distributors too. And what's really crucial for their stability, their risk mitigation, is that no single customer makes up more than 10% of their net sales. That really spreads the risk.
Yeah, that diversification is huge. And what really makes them stand out, I think, is that their products aren't just like optional extras. They're absolutely mission critical. They're the essential one-stop shop enabling this whole electronics revolution. I mean, look at their product categories. Their core, going way back to 1932, has been connectors. And these aren't simple plugs, right? We're talking super sophisticated fiber optic, high-speed data, power, RF interconnects, engineered for extreme environments too.
Exactly. Think deep subsea, think outer space.
Yeah.
And they need miniaturization, high power, EMI shielding. That's electromagnetic interference protection. Crucial for reliable signals.
And it's not just connectors. They've grown massively in sensors, especially after buying GE's Advanced Sensors Group back in 2013. They've got a huge range: pressure, temperature, position, gas, moisture sensors, all for really demanding applications. Plus, their high-performance antenna solutions for everything from cell towers to cars, and their cable and interconnect systems, specialized cables, complex assemblies for power and data.
And their position in the market. It's formidable. They're not just big, they're the second largest globally in the connector industry. That size gives them huge operational efficiencies, supply chain resilience, and, frankly, the R&D muscle to stay ahead. They've got over 130 manufacturing sites in about 40 countries, something like 125,000 employees.
Yeah.
This global scale lets them serve customers locally, North America, Asia, Europe, all big chunks of their sales in 2023.
So their main value proposition, it really boils down to providing these highly engineered, mission-critical bits for reliable power and data in really complex situations. They're more like a technology partner, getting involved early in customer designs. That creates really sticky, long-term relationships.
And the whole industry they're in. The electronic components market is massive, projected to grow from almost $4 trillion in 2024 to over $4.2 trillion in 2025. That's nearly 8% growth a year. And it's not just steady growth, it's fueled by these huge tech shifts happening right now.
Oh, absolutely. Like artificial intelligence and data centers. That explosive growth means massive demand for high-speed, high-power, thermally efficient interconnects. The AI chip market alone
Hmm.
projected over $150 billion in 2025. Amphenol's right there. Then you've got the Internet of Things, IoT and 5G. All those billions of connected devices hitting over 25 billion by 2030. They all need connectors, sensors, antennas.
Right, and don't forget automotive electrification and automation, EVs, driver assist systems. They just pack in more electronics. So huge demand for specialized connectors, high voltage stuff. That market's growing over 18% a year through 2032.
Plus industrial automation, Industry 4.0, smart factories, robotics, all needing more sophisticated interconnects. Amphenol really has its fingers in all these high-growth pies.
Now, the competition, it's fierce, definitely. It's fragmented too, lots of players. But the big ones are Amphenol, TE Connectivity, Corning, Molex, Broadcom, Littelfuse. Those are the major forces. But what sets Amphenol apart, financially at least, is performance. Their net margins, like 15.6% compared to Corning's 3.3%. The return on equity, nearly 28% versus Corning's 16.5%. And they've been grabbing market share too, almost 14% in Q1 2025.
Okay, and regulations, mostly standard environmental health safety stuff, right? But the bigger issue seems to be geopolitical trade policy. We'll definitely circle back to that later as a key risk. But right now, think about this. What stops someone new from just jumping into this market? You mentioned the barriers to entry are really high, didn't you?
Oh, incredibly high. This isn't a garage startup kind of industry. First, you need billions for capital-intensive production and R&D just to get in the game. Then there's economies of scale. Amphenol's global size gives them a structural cost advantage smaller players just can't touch. And maybe most importantly, high customer switching costs. Once Amphenol's parts are designed into a platform early on, it's super expensive and time-consuming for that customer to switch suppliers. They're locked in, essentially.
Like an ecosystem.
Exactly. And finally, brand, reputation, and trust. They've built that over 90 years, delivering quality and mission-critical stuff. That's invaluable.
So, Amphenol's durable competitive advantage, its moat. It's built on that brand, the cost advantages, the switching costs, and crucially, that broad tech portfolio and amazing diversification. It really is a picks and shovels play, isn't it? They're not betting on one specific tech winner, but on the whole revolution.
And what's really fascinating and often missed is their entrepreneurial culture. They empower these decentralized local managers. It gives them incredible agility and speed despite being massive. It's like having the resources of a giant with the focus of a smaller company. A really powerful, non-obvious edge.
Okay, so we've got a handle on the powerful business itself. But, a company, no matter how great its products, is only as good as its leadership. Let's turn now to Chapter 2, Management Evaluation, a culture of performance and prudent growth.
Yeah, the leadership here is remarkably stable and experienced. The CEO, our Adam Norwitt, he's been with Amphenol since '98, CEO since 2009. And under his watch, they haven't just grown. They've compounded value incredibly well. We're talking an average of 11% annual sales growth. And get this, 12% annual adjusted EPS growth for a whole decade, 2013 to 2023.
Wow.
Yeah, that kind of consistency, even through different market cycles, is really rare. It speaks volumes about their diversification and agility.
And how do they communicate? Are they transparent?
Very. Their earnings calls are clear, very data-driven, give detailed financial guidance, have a solid investor relations program, and importantly, you don't see any major ethical scandals hanging around them.
Good sign. What about how they use their money? Capital allocation.
Highly disciplined, very strategic. First priority is always reinvesting in the core business, like $665 million in CapEx in FY24 for new tech, manufacturing upgrades. Then M&A, mergers and acquisitions. That's a core pillar, accounts for maybe a third of their long-term growth. They're disciplined here too. Strategic buys to add tech or market access. They've done over 50 deals in the last decade. Recent ones include LifeSync in medical, Lutsit in harsh environments, CIT, CommScope businesses.
So they're building strategically. And what about returning cash to shareholders?
Absolutely. Consistent, meaningful share buybacks, like $689 million bought back in FY24, another $180 million or so in Q1 25. And the dividend, rock solid. 13 or 14 straight years of increases, haven't cut it in 19 years. They even bumped it up by 50% recently, July 2024. And the payout ratio, the percent of earnings they pay out, it's low, 25-31%. Very safe, lots of room to grow it further.
That's reassuring for income investors.
And if you want the ultimate grade on how well they use capital, look at return on invested capital, ROIC. Amphenol's ROIC is exceptional, consistently between, say, 16% and 18%. That beats over 90% of their peers. It's proof they're not just spending money, they're creating real value with it.
So it fuels itself in a way.
Exactly. Management calls it a virtuous cycle. Strong execution, lots of free cash flow, smart deployment into organic growth and M&A, better tech and market position, more growth, even stronger cash flow shareholder returns. The main risk really is if they somehow lose that discipline in capital allocation.
Okay, that makes sense. But there's this interesting point about insider transactions, isn't there? Seems like over the last, say, 6 to 18 months, there have been quite a few big open market sales by top execs, CEO Norwitt, CFO Lampo included, but zero open market buys. That always makes you wonder.
It does, and context is absolutely key here. These sales happened during a period when the stock price hit historic highs, and the valuation was, well, pretty rich. Often, these sales are tied to exercising stock options. Executives get options, the stock runs up, they exercise the options and sell some shares. It's often about diversifying their personal wealth.
So not necessarily a red flag about the company itself.
Probably not a bear signal on the company's future, no. More likely rational diversification and taking some profits off the table, but it might suggest that management themselves sees the stock as, fairly valued, maybe even fully valued, at these current high levels.
Right, so maybe less of a get-out-now signal and more of a hint that the easy money might have already been made in the near term. Perhaps reinforces that fairly valued idea.
I think it's a very reasonable interpretation, yeah. It aligns with the valuation picture.
Okay, let's crack open the books then. Time to get into the nitty-gritty. What we find here is, well, you called it a fortress earlier. Let's dive into Chapter 3. Financial analysis. A fortress of profitability and cash flow.
Okay, starting point. Market cap around $113 billion. A serious player.
And the revenue growth. Pretty stunning. 5-year average of 15.6%. They hit a record $15.2 billion in FY24, up over 21%. And trailing 12-month revenue is even higher, almost $16.8 billion. This thing is growing fast.
And they're doing it profitably. Margins are consistently high and actually expanding. Gross margin around 34%. Adjusted operating margin hit a record 21.7% in 2024 and pushed even higher, 23.5% in Q1 2025. Net profit margin around 15.6%. That's better than over 93% of their peers. Shows real efficiency and pricing power.
And the free cash flow.
Yeah.
You described it as prodigious and consistent. About $2.2 billion in FY24. That's the fuel for everything, right? That virtuous cycle you mentioned.
Absolutely. That cash funds the R&D, the M&A, the buybacks, the dividends. It's the engine. And remember that slight revenue dip in 2023. That was actually a great test. The broader electronics market had headwinds. Things slowed down. Amphenol stayed highly profitable, generated record free cash flow even with flat sales. That really proves the quality and resilience of the business model. It's easy to look good when everything's booming. Amphenol looked good even when things got tougher.
Like a stress test they passed with flying colors. So the balance sheet is strong then, a fortress, as we said.
Definitely. Earnings consistency. Over 10 years straight, profitability, net income trending up, debt to equity around 0.66 to 0.70. Very manageable given their cash flow. S&P Global Ratings agrees, notes their low leverage.
Liquidity looks good too.
Yep, healthy current ratio around 1.99, plenty of short-term liquidity.
And we already touched on the dividend stable, growing, safe payout ratio. It all paints a picture of serious financial stability.
It really does.
Okay, now, that valuation, this is where it gets tricky, maybe.
Well, it's where the fairly valued part comes in. Their trailing PE ratio is about 45.3. That's a big premium compared to the electronics industry average, which is closer to 34, and the overall S&P 500. It's also at the higher end of Amphenol's own historical range.
Right, that double-edged sword we talked about. It shows the market loves the quality and growth story. But it also means the stock is priced for near perfection. There's very little room for error, not much margin of safety for new buyers at this price. A small stumble could hit the stock hard.
Precisely. So to try and get an objective sense of value, we often use a discounted cash flow or DCF model. It's that Warren Buffett idea. A business is worth the present value of its future cash flows. For our educational DCF model here, we made some key assumptions. Growth rate. We used a two-stage model. Stage 1, first 5 years, starts at 15% growth, tapering down to 10%. That reflects the AI boost, analyst views, management guidance. Stage 2, the terminal rate, we set at 2.5%. That's conservative, kind of long-run GDP plus inflation. And the discount rate, the WACC, we use 9.0%. Seems reasonable for a stable, large-cap, tech-linked company like this.
Okay, so running the numbers through that model, what kind of intrinsic value does it spit out?
The estimated intrinsic value range from this particular DCF model is roughly $85 to $95 per share.
And the stock is currently trading at $93.81.
Exactly. So the DCF suggests it's trading right at, or maybe even slightly above, the upper end of its estimated fair value range based on these assumptions.
All right, so we've got the business, the management, the financials laid out. Now let's pivot. How is the market actually looking at Amphenol right now? It's time for Chapter 4, Market Sentiment, riding the wave of AI enthusiasm.
Well, the short answer is overwhelmingly positive, almost entirely driven by this narrative of Amphenol being a key enabler, a crucial supplier for the AI revolution, plus 5G, plus EVs.
And the Wall Street analysts, they're definitely singing its praises. It's got a strong buy consensus rating. Average broker recommendation 1.5M from 16 firms. That's what, 12 strong buys, 4 holds, and 0 sells.
Correct. And the average one-year price targets, they tend to cluster right around the current price. You see numbers like $93.53, $91.56, $100.50, though the range of forecasts is pretty wide, $70 on the low end, up to $110 on the high end.
So some dispersion there.
A bit, yeah.
Yeah.
And the recent news flow, media coverage, exceptional positive, all focused on record results, the growth in IT datacom, those strategic acquisitions. It's constantly cited as a top play on the AI boom.
Which, raises that important question for you, the listener, when everyone agrees, when it's such a consensus trade. It reflects strength, sure, but it also means expectations are incredibly high. Less room for positive surprises, more risk if anything disappoints. A potential flag for contrarian thinkers, maybe.
Absolutely. It's something to be aware of.
Yeah.
And the market indicators back up this bullish consensus. Short interest, for instance, is super low, like 1.45%, 1.47% of the float. Days to cover also very low, about 2 days. Means very few people are betting against the stock.
In the technical charts, what are they saying?
Very strong momentum. The price, $93.81, is trading significantly above its 50-day moving average. That signals a strong uptrend. And it's substantially above its 200-day moving average, indicating a really solid long-term uptrend is in place.
Clear upward trajectory, then.
And recently, it had what technicians call a golden cross. That's when the shorter-term 50-day average crosses above the longer-term 200-day average. It's often seen as a strong confirmation of a bullish breakout, suggesting more upward momentum could follow.
Okay, bullish sentiment, bullish charts. Now, who actually owns the stock? That tells us a lot. Let's look at Chapter 5, Ownership Structure. A vote of confidence from institutions.
Well, this is quite striking. Institutional ownership is extremely high. Around 97.2% of the available shares, the float, are held by big institutions. We're talking giants like the Vanguard Group with nearly 13%, BlackRock with over 8%, Fidelity FMR also over 8%. That's a massive vote of confidence from respected, long-term focused asset managers. They clearly see Amphenol as a core, high-quality holding.
Okay, massive institutional confidence. But then you contrast that with insider holdings, which are tiny, right? Less than 0.5%. And we already talked about those significant open market sales by executives and 0 buys. How do we square that circle? Big money buying, insiders selling.
It's a common pattern, actually, especially with high-quality growth stocks that have run up a lot. The institutions are making long-term strategic bets on the quality of the business and its growth prospects. They're confirming the underlying strength. The insider selling, as we discussed, is more likely tied to personal financial planning diversification, taking profits after huge gains, often linked to options. It probably reflects their view on the current valuation being full, rather than a negative view on the company's long-term future.
So 2 different perspectives reflecting different goals and time horizons, perhaps.
Exactly. And one implication of that high institutional ownership is that the stock's performance can be heavily influenced by the decisions of a relatively small number of very large fund managers. Their buying or selling can really move the needle.
Makes sense. Okay, no company analysis is complete without looking at the risks. What could go wrong? Let's turn to the potential pitfalls in Chapter 6. Risk assessment, navigating geopolitical and cyclical headwinds.
Right, so we can use a SWOT framework here. Strengths, weaknesses, opportunities, threats. We've covered the strengths, that amazing diversification, technology leadership, strong financials, disciplined M&A, wide moat.
And the weaknesses, mainly that exposure to economic cycles, right? Raw material price swings, complex global supply chain.
Exactly. And the opportunities are huge. AI, data centers, EVs, automation, IoT, 5G, all massive tailwinds.
But then, the threats. Geopolitical tensions, tariffs are a big one now, a potential macroeconomic slowdown, intense competition, and always the risk of technology changing fast, making products obsolete.
And it's worth highlighting that paradox of diversification again. Amphenol is diversified across different types of markets. It's a strength. cushions against sector-specific problems.
Yeah.
But it also means they have broad exposure to cyclical markets in general. That's a weakness in a big global downturn.
Yeah.
They're resilient, but not totally immune if the whole economy tanks.
Okay, let's drill down on those threats. Macroeconomic factors, a big global slowdown would hurt revenue and profits, obviously. High inflation could squeeze margins too.
For sure. But maybe the most acute immediate threat right now is geopolitical, specifically the U.S.-imposed tariffs of 2025. These are sweeping new tariffs like a 10% baseline, but hitting 50% on Chinese semiconductors impacting finished electronic goods. That means direct cost increases, potential supply chain disruption, just a lot of uncertainty for companies importing components or finished goods.
Yeah, that sounds like a significant headwind. But what's fascinating here, doesn't this threat also kind of highlight one of Amphenol's biggest strengths? That globally diversified manufacturing footprint. Having factories in 40 countries must give them flexibility that others lack, right? To shift production around.
Absolutely. It's a huge competitive advantage in this environment. That operational agility allows them to potentially mitigate some of the tariff impact by moving production. So yes, the tariffs are definitely a headwind. But Amphenol is arguably much better positioned to navigate them than many rivals. They might even gain market share if weaker competitors struggle more. They could actually emerge from this period in an even stronger market position, paradoxically.
Interesting dynamic. Okay, we've covered a lot of ground. Business, management, financials, market view, ownership, risks. Time to bring it all together. The moment we've been building to, Chapter 7. Conclusion. A premium price for a premier performer.
So summing up the bull case for Amphenol, you've got market leadership in critical sectors, exposure to huge secular growth trends like AI and electrification, exceptional management doing smart capital allocation, fortress financials, and a really durable competitive moat. It's a quality operation.
But then the bear case, or maybe just the cautious case, that high valuation is the big one. Price for perfection, little margin of safety. Then there's the cyclical exposure, those geopolitical and trade risks, and the fact that it's such a consensus, crowded trade right now.
And just to reiterate our valuation summary from the educational DCF model, that estimated intrinsic value range was $85 to $95 per share. The stock price at $93.81 is right near the top end of that.
So pulling it all together, what's the concluding outlook? What does this all mean for you, the listener?
Well, it seems clear Amphenol is a premier high-quality business, a classic example of a long-term compounder. This isn't some, fly-by-night tech stock. The key takeaway, though, is that the market knows this. It's fully aware of Amphenol's strengths, and the current valuation reflects a lot of optimism about the future. Therefore, the stock appears to be fairly valued. The price accurately reflects its quality and growth, yes, but it also carries the risk that comes with any high-multiple stock price for near perfection. There's just minimal margin of safety for new investors at this level.
It's a great company, but maybe not a great bargain right now.
That's a good way to put it.
So here's a final thought for you to chew on. When a truly great company, like Amphenol, is priced for perfection, does that mean the opportunity for new money is just gone? Or maybe it challenges us to think even longer term about its compounding power over many years, even if we start with a smaller margin of safety today. Something to consider. This deep dive, like all our episodes, was designed to be your shortcut to being genuinely well-informed. We hope we gave you the key insights to think critically about Amphenol. And one last time, please remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And members, don't forget, you can suggest stocks for future deep dives in the comments. We prioritize those suggestions.
And the important disclaimer. This analysis was generated by an AI system. It's for educational purposes only. It should definitely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. Thanks so much for joining us on this deep dive. We'll see you next time.